A 20 to 30% bear market in residential real estate, according to one economist, and apparently he's being quite charitable. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is March the 22nd. Hope you're doing well. Randy Patrick here, putting the realism back in real estate. Once again, every day is a new adventure in the world of real estate. Nothing surprises me anymore. And, again, I don't get fazed by it. But I'm telling you right now, trust your gut, trust your instinct. Nobody feels good about buying property right now at the sort of rate things are going. This video is brought to you by our friends at Foreclosure.com. So if you'd like to find out and check out all the distressed listings in your neck of the woods in your backyard, go to gethousingdata.com. That's gethousingdata.com. Check it out. There's a free trial. You can really see what's happening with respect to distressed properties. Again, our partnership with Foreclosure.com, they are the #1 provider of distressed property listings across the nation. So there you go. Please check it out. You'll feel good about yourself when you see what's going on behind the scenes. All right. So we have to start off with today's mortgage rates. Okay. Today's mortgage rate trends. Well, guess what? We got a 30-year fixed at 4.72%. So we've seen a significant increase in residential mortgage rates, right? Obviously, refinancing is a little bit higher. So what's happening? What's going to, cause some market confusion and some market frenzy? So what we're hearing in the media right now is, again, expectations of double-digit appreciation. I'm still seeing articles and hearing about this in the news that, Zillow and whoever are saying, yeah, we're going to see double-digit for 2022, so don't worry, etc. Bidding wars are back again, apparently. Again, still having low inventory and, obviously people are still clamoring for homes. They're basically saying now that we're into March, it's kind of the start of the spring/summer selling season. And what the real estate agents are telling people now is get your home now. Just go ahead and buy it. You know why? Because you want to beat the rate increases. Get it now, refi later when the rates drop. That's the comforting sentiment they're giving to their buyers out there. So we'll have to see what's really true. But what's really going on is we know purchase applications are down, according to the Met Mortgage Bankers Association. This stuff, basically they look at this on a weekly basis. So when applications drop, right away you can tell that there's a difference. When rates change, the correlations is immediate changes in applications. So purchase applications are down, refi applications are down big time. There's a general sales slowdown in real estate right now, so things are slowing down with respect to sales volume. And we have low buyer sentiment. The reason we have low buyer sentiment because of what? The economy, inflation, increase in mortgage rates. There's a whole myriad of things, but guess what? Buying a home is not as exciting as it used to be back in the day. So that's where we are today. But I really wanted to get involved now to sort of really hit this right off the top here because, we've been talking about this for a number of years. And yeah, there's been some delays and moratoriums and things that have sort of choked the market and sort of kept it going. A little bit of artificial, inflation here, a lot of quantitative easing over the years from the Fed. But guess what? We've got a gentleman here. He's an economist, a strategist. His name is David Rosenberg. And basically he's saying here that prepare for a recession this summer, a bear market in real estate and a drop in stock prices, warns strategist David Rosenberg. So we're going to take a quick little deep dive into an article. This is via Market Watch, via Bloomberg, I guess, here. So David Rosenberg is convinced the Fed will beat inflation so hard that the U.S. economy will slide into recession as early in the summer. So we're going to just go right to the housing stuff, okay? Demand destruction means bursting asset bubbles that typically mean lower valuations for housing stocks and other cherished investments. You're on record about residential real estate being at peak housing. What convinces you that the U.S. housing sector is in a bubble? So I guess Market Watch is posing that question to Mr. Rosenberg. His response basically is, the housing market is in at least as big a bubble as the stock market. When you look at price action, it's absolutely incredible. The year-over-year trend in nationwide home prices is 19%. We've already taken out prior bubble peaks, 70s, 80s, mid-2000s. Relative to overall inflation, housing is overvalued by 35%. And by 27% relative to wages. So we've always been clear here saying, yes, we've had significant home price appreciation over the past number of years, and that's far outpaced wage appreciation. So there's a big disconnect there, which, he's agreeing with that here. Home prices relative to residential rents are 25% overvalued by the standards in the past. A single-family home now absorbs more than 8 years of Americans' personal income, which is almost 50% higher than the average going back to 68. So obviously takes way more of your money to get in housing. The whole thing here is that it says housing, like equities, a long duration asset and benefiting from years of accommodative monetary policy, is again ensnared in a mess of price bubble. Price to income multiple is just about where it was in 2006 and 2007. Nobody wanted to believe it then. And talking about housing being in a bubble today, it's as if I told somebody that their kid was ugly. So yeah, this is what we see out there. People don't want to believe it, and that goes back to your basic bubble theory. One of the I guess you say the components or parts of a bubble theory 101 is the fact that when you're in a bubble and things are good and it seems like it's going to keep going and keep going, you don't want to believe that there could actually be an end to the bubble. Nobody wants to think of a crash or a change or some inflection point. They keep thinking it's going to go up and go up, so they're actually being lulled into a false sense of security, and it's almost like it's a drug. They're being the euphoria of watching that value go up. Again, it's all on paper. Like, how many times do you go on Zillow and type in your home address and go, wow, look, last month was X and now we gained $10,000, $20,000 more in equity just because it's the next month. I mean, people do that. It's a tempting thing to check this out, and that's what's happening right now. Now, this is actually interesting. Historically, home prices go up 1 or 2 percentage points above the inflation rate. Right now, it's going up 12 percentage points. That's actually huge. And basically, the excess is practically unprecedented. The laws of mean revision are telling you that we're going to have anywhere from a 20% to 30% bear market in residential real estate, and that's being charitable. So my first statement, in the video here was that's what he's saying, a 20 to 30% bear market. What's a bear market? Prices are falling, reduction in values, all right? So he's being charitable, which means there could be more. And once again, nobody seems to believe it, let alone prepare for it. So that's kind of what we got going on here. So as I always mention, we got a housing narrative telling us it's going to keep going up, jump in now before the rates get too high, etc. And you've got real economists now. So what we're seeing is more people are speaking out against the narrative and saying, listen, whether it's stocks or oil or housing, we're going to have some problems. We're going to have price situations, and we're going to have some correction, or things are going to happen to bring us back down to earth over the past few years. So again, nobody seems to believe it, let alone prepare for it. And that's the number one thing when it comes to housing, is that you don't know. Well, put it this way, back in the last housing crisis, we didn't know till it hit us. Now we can see it coming a mile away. We have the stats, we have the information, we have the internet, much more sophisticated data right now that we're looking at. We have the experience of going through the last cycle. That's what I look at constantly, so I know that this is going to happen. It's just we are such an impatient society right now, is that because everything is so readily available to us from an information and data perspective, that we want it to happen now, and having to wait 3 months, 4 months, 6 months, a year doesn't sit well with us and gives us anxiety, and then we don't believe what's going to happen. So again, this guy, he's an economist, and I'm assuming that he's got a number of degrees, and it looks like he's been doing it for a while, and he knows what he's talking about. That's his perspective here. What ultimately pulls the rug out from under the housing market is the Fed, because housing is the most interest rate sensitive segment of the economy. As I mentioned, the minute there's a rate change, the next week from the Mortgage Bankers Association, they can tell us whether applications went up or went down based on that subtle movement. Each Fed-induced pricking of the real estate bubble also played a big role in the eventual recession when you consider the importance of this sector and its multiplier effect across the broader economy. So yeah, housing, I've talked about this in videos probably over a year ago, but when you actually take a look at our GDP, and when you actually factor in the housing market, when I mean housing, it's construction, real estate sales, rental, Home Depot, title companies, mortgage. You take a look at all, that's a very broad component of the GDP in the industry. It's about 25% overall. So if the housing market takes a hit, our overall economy and GDP takes a big hit as well too. So it's very important to what happens in the future. So that's kind of the thing here. So again, so there's a guy, an economist, the summary of this, that he's talking 20 to 30% bear market being charitable, which means it could actually be more than that. So we'll have to see how that plays out. But listen, I'm not telling you this. I'm just regurgitating what this gentleman is saying, David Rosenberg, and I'm assuming he sort of knows what he's talking about. So what we're also seeing is now that based on sales, etc., the housing market is in the early stages of a substantial downshift. home sales may drop 25% by end of the summer, according to this analyst. So not only are economists sort of saying, well, we're going to have some major problems, but we're actually seeing this unfold between, right in front of our eyes here. So we're going to see sales slowing down. They did slow down for the month of February. All right, expectations that we're going to get a little uptick for the summertime, and I guess that's one thing I want to caution people on too. So right now, everyone's saying it's going to slow, but we'll get that false sense of security because as we enter the spring summer selling season, we're probably going to see some increases, some activity. It's going to look like, hey, the market's rebounding, recovering. Look at here. This is going to be great. But then afterwards, we'll start to see the slide, and we'll feel a lot more. So, but again, home sales dropping. Why? Because, as I said, the minute rates go up, people pull back, and right now there's a lack of confidence in the economy and what's going to happen in the very near future. So. Basically, he's projecting home sales will drop 25%. So he's not talking about values. He's talking about the volume of home sales. So the annual pace that just came out from NAR, I didn't even do a video on that because honestly, it's boring. It's the same thing over and over again, right? Why talk about it? We know where it's at. The annual price is about 6 million. That's a seasonally adjusted annual rate of sales, about 6.02 million units being sold for the year of 2022. He's thinking the rate's going to go down to about 4.5 million by the end of the summer. That's actually putting us back into COVID times where, same thing, we were tracking about 6.5 million during COVID, and when that hit, it brought us down to about 4.5 million on the SARS. So, again, the evidence of this expected slowdowns in home sales, basically we can see it. The purchase, mortgage, home purchase loans are down. Applications, demand for refinancing has dropped nearly 50% versus last year. So we're seeing stuff, really sort of take hold here. And again, when I say trust your gut, it's kind of like, do you feel good about this? That's how I look at it. Going, if I wanted to buy a house right now for my family, I wouldn't feel good about it. I'd feel pressured. I'd wonder, am I making the right decision? What am I going to do? Are things going to change? Because we don't have a crystal ball. So I understand we don't have crystal balls, but what we do have is, I call it the proverbial time machine. All right. And the cool thing about the time machine is that we can go back in time and see what happened during the last housing crisis and how that played out, and use that knowledge and that experience to sort of predict what's going to happen in the future and position ourselves correctly. So, as I said, did lots of deals. We did hundreds of deals back in the last housing crisis, okay? We did short sales. We did foreclosures. We did all sorts of stuff here, okay? We sold some. We bought some. I was the real estate agent broker on some. So kind of all over the place. And one thing you guys don't know, because I don't really talk about it because it's not the right forum here, but, I actually was involved in some lobbying efforts up in Washington with a group. It was called the Distressed Property Coalition. And ultimately, we wrote or crafted the national short sale policy that's adopted by all of the government entities and most of the banks and lenders right now. So, I'll talk about that in a future video, because ultimately the government, mainly Freddie Mac, was gunning for real estate investors, the mom and pop type, smaller investors. So a lot of story and history to go along with that. But again, my perspective is I get the housing market. I kind of understand how it plays out. I understand how hedge funds and Wall Street and lobbying and the government and the economy all play a big part into this, and things that we really can't control or have little control or say in. That's a big part of what happens in the industry. But again, I digress here, but just letting you know that there's a lot of stuff that goes on behind the scenes that people don't even know really exists in housing. But the point I'm trying to make here is that half the buyers on a recent survey said affordability is their biggest concern. But they're still optimistic that they'll be able to buy a home next year. So, what are we going to see here? Well, we don't know. I mean, how many times will the Fed raise their rates? Well, apparently it's going to be 7 times in 2022. And we have economist groups say, like Goldman, say maybe it's going to be 8 times. Now, here's the thing here. A one-time increase in savings can't finance an increase in mortgage payments for the next 30 years. So if you do have an increase in your savings, is that really going to play a big role in the amount of dollars you're going to pay in interest over the next 30 years? So I guess you have to take a look at that to see how much it's going to hurt you in the pocketbook. But again, a lot of us, when we look at purchasing a home, you're not really concerned about the actual interest you pay over the 30 years. You're more concerned about your monthly payment, so whether you can afford it or not. So if we see a drop in demand, then it's going to lead to a boost in inventory as a home for sale. But basically, homeowners are going to go, if I need to sell, better sell now and put it in the marketplace. But he also cautioned that many sellers could pull listings or decline to put them on the market because no one wants to be the last person trying to sell their home in a falling market. So everyone says, yeah, you want to try to catch that falling knife, right? You want to avoid catching the falling knife and being the last person, grabbing, the buying the property at the peak before it kind of goes the other way. And I get that, but just be aware that, you got to trust your gut, trust the market, trust what's out there. I think by now we have a lot of data out there. We have a lot of information, a lot of perspectives, a lot of people other than myself who are much smarter and much more learned and, etc. They kind of see the writing on the wall. When I tell you all my contacts, which are, we're talking very wealthy investors, people who move hundreds of units a year, they're all preparing for this as well too. So it's kind of like you can take advantage of it now if you want to buy and sell now because it's an up market, but knowing that at some point in time it's going to correct and you need to prepare your business or yourself for that. So that's what happens in the world of real estate. So ultimately, in the end, it's just one of those things where, like I said, trust your gut. Does it make sense? So, well, first of all, if you're not a subscriber to my channel and you appreciate the information I put out, if you could do me the great honor and smash the subscribe button, I'd really appreciate that. And if you are a subscriber, please reaffirm your subscription because I do lose subscribers every day off the medium here. So I actually net out. I grow very slowly. I'm losing as much as I put on. So please, if you could just smash it again or resubscribe, I'd really appreciate that. Thank you for the views and likes and comments as always, guys. All right, this now is kind of the slow part, I guess you could say. Well, see, other people are it's not this one guy, David Rosenberg. So other people are basically saying Fed rate hikes will crack U.S. economy and the housing market. Basically, that's this guy is called Bill Gross. He's founder of PIMCO, and he's called the bond king of Wall Street. Basically, publishes books and gives his insight on this. He's basically saying, yeah, the more they raise it, it's going to crack the housing market. But it's kind of like, where can we go? There's only so much QE we can have. Now it's time for a little bit QT, quantitative easing versus quantitative tightening, right? So we're trying to put things back in perspective. It gets to the point where only when the loan limits are going up. So it's kind of like the result is, well, if market pricing is going higher and higher, we'll just increase our loan limits to accommodate those increases in pricing. So it's not really helping the consumer or the home buyer. It's just basically allowing you to stretch farther, and they're being more generous on their loans. So this is something that has to happen. The Fed tightening and raising the rates is something that really needs to happen with the housing market to sort of bring it back down to earth and therefore balance the market out. So we will see what happens in the next little while. But it's the start. Okay. Fed's median projection, as expressed, the latest dot plot shows 7 rate hikes in 2022, which would leave the Fed funds rate, the central bank's benchmark interest rate, at a peak of 2.75%. Again, having the interest rates where they were on the first slide I showed, about 4.72%. That's the highest mortgage rate since 2018. So obviously, we saw that there's been huge appreciation since that time. 2019, 2020 over COVID. Now when we're out of COVID, we've seen massive appreciation after COVID was over. So that's where we're at now. Considering the Fed expects it will need to cut rates later in 2024 to accommodate a slowing economy. Well, so there you go. So, this is just where we're at right now. So the quicker they raise rates, the quicker the changes are invoked, and we'll see how it plays out. I'm not even talking about the foreclosure volume and stuff like that yet, but just realize that that's the plan. The plan is to do, 7 or 8 additional rate hikes over the next little while. So obviously, as I said, NAR put out the information. Existing home sales tumble on double whammy of soaring prices and rising mortgage rates. So of course, I guess you could say existing home sales plunged a bigger than expected 7.2 month over month in February, the biggest month over month drop in existing home sales since May 2020. So obviously, this is volume of sales. This is not actual price points. So volume of sales did decline. We'll still probably see an increase in median price because, again, a lot of the homes that are being sold now are 500K, 750K, million K and above. And that's where, obviously that's bringing the median price point up here. This is a 6-month low for existing home sales, and it will likely get worse as these are deals that were likely set in December when mortgage rates were significantly lower. So you've heard of what's called pending home sales. There is an index. I don't even talk about it on this channel because pending home sales are basically, signed contracts, but they're not closed yet. So, you can basically what they're saying is that stuff that's closing now in February is probably on a 35, 40, 60-day cycle. So people did these contracts back a couple months ago when rates were lower. So now as we move forward, if we're into higher mortgage rates, we'll see less sales activity, less contractual activity, less pending sales on a going forward basis, which will in 60 days manifest out and show an even greater reduction in sales volume. So that's kind of where we are on that. Ultimately, in the end, according to Lawrence Yun of NAR, National Association of Realtors, the sharp jump in mortgage rates and increasing inflation is taking a heavy toll on consumer savings, which is quite obvious. However, I expect the pace of price appreciation to slow as demand cools and as supply improves somewhat due to more home construction. So they do talk a lot about home construction, new home construction, but I don't really see, that suddenly, adding so many units to the housing market where it's going to make a huge difference. That's the one thing, because that statistic is provided by the Bureau of Labor and Statistics, and that is a rolling number based on new home sales, permits, whatever. Things are always adjusted after they report it. So ultimately, in the end, its SAR number, its seasonally adjusted number, is always lower than expected or they would like. And I know that I saw today that home builder sentiment is down to 3-month lows as well. So they're already feeling the pinch. And that goes to delivery of homes, it goes to sales prices, it goes to material and delays with respect to supply chain, things like that. So right now, the current pace with respect to inventory is 1.7 months. Now, when we talk about housing inventory, what we basically talk about is the time it takes to sell the home. So 1.7 months of inventory basically means that if no new listings came on the market, or no, in this case, this is because we're talking about existing home sales, if no new homes were listed on the marketplace, it would take 1.7 months of the current sales pace for all those homes to disappear, and we'd have no homes left to sell. So that's what we talk about the inventory and the month deal here. So economists, real estate agents, whatever, say that 6 months is basically a balanced market. So we can see that we're pretty much less than a third of what would be a balanced market, right? So there you go. All right. So again, as I always say, two housing markets at play: the mainstream retail market, which is on market, which is MLS, existing home sales, and the shadow inventory, which is off market, things you don't see because they're not floating to the surface yet. Now, just keep in mind, I put the slide up last video, our rolling distress statistics, right? We're going to see articles, I didn't even bring them up today because I got enough to talk about, but about how we're seeing forbearance numbers change and people coming out of it and whatever. Well, again, 2 billion people are coming out of forbearance. A certain percentage are going to have programs that are going to work for them. A certain percentage are going to have programs that don't work for them, and they're going to fall in the foreclosure bucket. A certain percentage will fall out of their current programs and fall into the foreclosure bucket as well, too. 51% of delinquent loans are not in any loss mitigation program, which means they're floating out there, and they're going to keep going down the foreclosure pathway. 72% of those loans that are in a loss mitigation program are not paying. So that's why when we see these, I call it this the statistical analysis of what's going on in the distress side is very difficult to wrap your head around and your hands around. Because you keep getting these nuggets like, okay, well, 51% are not in the loss mitigation program. Okay, 72% of those in a loss mitigation program are not paying, which means you're not paying, you shouldn't be in the program, which means they're going to move you to the foreclosure side. You see, and our estimate, again, I'm not bearish, I'm bullish on the fact that we're probably going to be right in the middle, estimate of 3 to 10 million foreclosures. We've had people talk all over the map on this. So we'll just say for grins here, why don't we put it in the middle at 7.5 million foreclosures, which certainly would be enough to change the market and make people make some changes and reduce some prices, etc. And there's a whole play on that, which how I like to talk about that. So anyway, what have I noticed? More deaths. I talk about that as well too. More deaths are happening since post-pandemic for various reasons. We're actually seeing more estate and more probates out there right now. These are people with mortgages, homeowner association foreclosures. So down here, I don't know whether this is more unique to our location in the U.S., but we have a lot of homeowner associations here, a lot of condo associations, etc., being here in the state of Florida. And I'm seeing a lot more of those entities trying to foreclose on the properties and the owners who aren't paying their dues, etc. That's going on. We're seeing more layering. What I mean by that is you could have a probate or a need to probate situation because someone's passed away not paying their mortgage. So we're seeing like a layering a multiples effect on problems associated with distressed housing. We'll see some landlord fallout for sure. Landlords, why are rents going up? Well, landlords are probably going, well, number one, I can raise them. I get better quality of tenant, and also I need to recoup some losses from back, when there was moratoria out there. So they're doing that. More unpaid property tax. We're still going to see a ton of tax deeds going on every year. There's typically tax certificates that are sold, which eventually become tax deed sales. So something to keep your eye on for the future. So that's the scoop on that perspective. So again, all into the distressed housing realm there. I'm working on build to rent, build to flip opportunities. You want to get involved, contact me on that. Obviously, we'll be launching our 8-week live training the next couple of weeks. I'm going to have my first training probably first week of April. So if you want to get in that program, get on now. Short sale program, it's over, guys. It will come back as a different format. So if you want more information, this is where I think everyone should be because of the great opportunities as we move forward with foreclosures and pre-foreclosures. So that's, if you want more information, I'll tell you what's going to happen, and you can get on the list for that, okay? So that's the scoop. Once again, want to reach out to me. Here is my best ways to hit me up on my email address, all right? And that's kind of it. So want to thank you for the views, the likes and comments. Oh, here's I zoomed by a slide, so you've seen it before. It's the good margin deal on that one. So stuff can happen if you look for it. Again, you want to connect with me? That's my email. Send me your contact information. We'll chat. I do appreciate the views, likes, comments. Please share the video with your family and friends. Again, we're at an inflection point. Things are changing. So trust your gut, trust your instinct. Look forward to speaking with you in a couple of days.